Mastering Project Finance. Principles, Practice and Applications. Table of Content. Financing the Future, One Project at a Time. Chapter 1, Introduction to Project Finance. Chapter 2, Core Principles and Concepts of Project Finance. Chapter 3, Market Landscape and Trends. Chapter 4, Project Development and Feasibility. Chapter 5, Financial Modeling for Project Finance. Chapter 6, Risk Identification and Allocation. Chapter 7, Project Contracts and Legal Framework. Chapter 8, Debt Instruments and Lender Perspectives. Chapter 9, Equity and Sponsor Considerations. Chapter 10, Alternative Financing Structures. Chapter 11, Insurance in Project Finance. Chapter 12, Political and Regulatory Risk Management. Chapter 13, Environmental, Social and Governance (ESG) Factors. Chapter 14, Monitoring and Reporting during Operations. Chapter 15, Case Study, LNG Import Terminal Project. Chapter 16, Case Study, Toll Road PPP Project. Chapter 17, Case Study, Utility Scale Solar Farm with PPA. Chapter 18, Case Study, Data Center Project. Chapter 19, Emerging Trends in Project Finance. Chapter 20, Lessons Learned and Best Practices. Financing the Future, One Project at a Time. Imagine standing at the edge of a barren desert, where the sun blazes down relentlessly. In 2 years, this expanse will host a solar farm generating clean electricity for millions. Or picture an empty field on the outskirts of a city that, in a few years, will be home to a state-of-the-art hospital, serving thousands of patients a day. These are not just engineering feats, they are financially engineered realities, made possible by the discipline of project finance. Project finance is the invisible engine behind much of the world's infrastructure. It is how we mobilize billions in capital to build power plants, toll roads, data centers, ports, and pipelines, assets that enable economies to grow and societies to thrive. It is where finance meets engineering, law, and public policy to turn ambitious plans into bankable, executable projects. But project finance is not for the faint-hearted. Deals are complex, multidisciplinary, and high stakes, often involving dozens of counterparties, multiple jurisdictions, and life cycles stretching 20 to 30 years. The stakes are enormous. If structured poorly, projects can collapse under their own weight, leading to write-offs, litigation, and reputational damage. If structured well, they can deliver predictable cash flows, robust returns, and transformational impact for decades. This book is designed to guide you through the entire project finance journey, from the spark of an idea to financial close, and beyond into operations and refinancing. Across 20 chapters you will learn how to identify and allocate risks to the parties best suited to manage them, how to structure bankable contracts, and design a capital stack that maximizes efficiency, how to build financial models that withstand lender scrutiny and market volatility, how to integrate ESG and sustainability considerations, now a non-negotiable part of every deal, how to navigate real-world challenges, illustrated with case studies from power, transport, renewables, and digital infrastructure. Whether you are a finance professional, lawyer, engineer, policymaker, or student, this book will equip you with the tools, frameworks, and mindset to succeed in one of the most fascinating and impactful fields in finance. We are entering a period of unprecedented infrastructure demand, from the global energy transition to the digital revolution. Trillions of dollars must be deployed in the next 2 decades to build the infrastructure of the future. Those who understand project finance will not just watch this transformation, they will shape it. Let us begin. Chapter 1, Introduction to Project Finance. 1.1 Understanding Project Finance. Project finance is a specialized method of funding large-scale, capital-intensive projects, in which repayment is primarily sourced from the project's own cash flows rather than the general balance sheet of its sponsors. Unlike corporate finance, where a company leverages its existing assets and revenues to raise capital. Project finance isolates the project into a special purpose vehicle, SPV, a legally distinct entity that owns, operates, and finances the project. This distinction is critical. By ring-fencing the project, investors and lenders can analyze its standalone feasibility. Success is not dependent on the overall creditworthiness of the sponsors, but on the robustness of the project's revenue model, contractual framework, and risk allocation. Typical projects financed through this structure include power plants, thermal, hydro, wind, solar, toll roads, airports and seaports, oil and gas pipelines and refineries, telecommunications infrastructure, fiber networks, satellites, data centers. The hallmark of project finance is limited recourse. Lenders have claims primarily on project assets and cash flows, with limited or no access to sponsors' balance sheets. 1.2 Why project finance matters. The global economy relies heavily on infrastructure. Roads, power plants, water facilities, and renewable energy projects require billions of dollars in upfront capital, but their benefits accrue over decades. Governments often lack the fiscal space to fund these projects on their own, making public-private partnerships, PPPs, and project finance essential tools. Key advantages include capital mobilization, attracting private capital into projects of national and global importance. Risk allocation, assigning risks to the parties best positioned to manage them. Discipline in structuring, projects must demonstrate long-term financial sustainability to attract financing. 1.3 Anatomy of a project finance structure. At its simplest, project finance consists of special purpose vehicle, SPV, a legal entity formed solely to own and operate the project. Equity investors, sponsors, typically construction companies, energy developers, or infrastructure operators who provide initial capital and expertise. Debt providers, banks, development finance institutions, or capital markets investors. Key contracts: engineering, procurement, and construction, EPC contract, fixed price and date certain to manage construction risk. Offtake agreements, power purchase agreements, PPAs, toll concessions, or supply contracts ensuring revenue predictability. Operation and maintenance, O&M contract, secures reliable long-term operations. Cash flow waterfall, defines the priority of payments, operating expenses, debt service, reserves, then equity distributions. 1.4 Case Study 1. The Channel Tunnel Eurotunnel Project. Background: the Channel Tunnel, commonly known as the Chunnel, is a 50-kilometer rail tunnel linking England and France, completed in 1994. It stands as one of the most iconic examples of project finance in history. Financing structure. Total cost: £9 billion, 1980s prices far exceeding original estimates. Financing: structured as a project finance deal through Eurotunnel and SPV. Debt: syndicated loans from over 200 banks. Equity: raised from public shareholders. Challenges: construction risk, significant cost overruns. Demand risk: initial traffic volumes were far lower than projections. Currency and interest rate volatility. Lessons learned: over-optimism in demand forecasts can threaten project bankability. Complex megaprojects need flexible financing structures to absorb shocks. Lenders now apply far stricter due diligence on traffic revenue projections for transport projects. 1.5 Case Study 2. The Quezon Power Project, Philippines. Background: in the late 1990s, the Philippines faced severe power shortages. The Quezon Power Project, QPP, a 440 megawatts coal-fired power plant, became a landmark privately financed infrastructure project in Asia. Financing structure. Total cost: $1.2 billion. SPV, Quezon Power Philippines Limited Co. Offtake: a long-term power purchase agreement, PPA, with the national utility NPC. Lenders: multilateral agencies, IFC, commercial banks and export credit agencies. Success factors. Strong contractual framework. The PPA provided predictable revenues. Risk allocation. Construction risk transferred to a turnkey EPC contractor. Fuel supply and O&M contracts secured. Multilateral involvement. Gave lenders confidence in regulatory and political stability. Outcome. The project became a benchmark for power sector project finance in emerging markets. Demonstrated how robust structuring can mitigate political and commercial risks. 1.6 The evolution of project finance. Project finance has evolved through distinct phases. Early roots 19th-20th century. Railroads, mines, and oil exploration were often financed on a standalone basis. Modern era 1970s to 1990s. Rise of large-scale energy projects, particularly in oil and gas, using structured project finance. Contemporary trends 2000s present. Renewables and clean energy dominate new financings. Digital infrastructure, fiber optics, data centers, satellites, is increasingly financed via project structures. ESG, environmental, social, and governance considerations are central to financing decisions. 1.7 Conclusion. Project finance is not merely a funding technique, it is a disciplined approach to risk allocation and long-term value creation. Its success depends on aligning the interests of governments, sponsors, lenders, and end users. The case studies illustrate two sides of the coin: the Channel Tunnel as a cautionary tale of over-optimism and complexity, and the Quezon Power Project as a model of well-structured bankable financing. Together, they highlight the need for rigorous financial structuring, robust contracts, and realistic assumptions. As we move through this book, we will deepen our understanding of how project finance structures are built, risks are allocated, and capital is raised to power economies and societies forward. Chapter 2: Core Principles and Concepts of Project Finance. 2.1 The DNA of Project Finance. At its core, project finance is about structuring a project so that it can stand on its own financial legs, raising capital solely based on the future cash flows of the project, with risks allocated to the parties best positioned to manage them. Unlike corporate finance, where a company leverages its balance sheet to borrow, project finance isolates a single project within a special purpose vehicle, SPV. This isolation is both legal and financial, creating a ring fence around the project's assets, liabilities, and risks. 2.2 Key Principles. Let's break down the 5 essential principles that underpin successful project financing. 1. Limited or non-recourse financing. Definition. Lenders primarily rely on project cash flows and assets for repayment, rather than the corporate balance sheet of sponsors. Why it matters: this shields sponsors' other assets from risk and allows them to fund multiple projects without overburdening their balance sheets. Implication for lenders: they must thoroughly assess the project's revenue-generating ability, contractual security, and risk profile before committing funds. Example: in the financing of a 500 megawatts solar power project in India, lenders provided non-recourse debt based entirely on a 25-year power purchase agreement, PPA, with the state distribution company. The PPA guaranteed predictable revenues, making the project bankable without requiring sponsor guarantees beyond equity commitments. 2. Risk allocation and mitigation. Risk allocation is arguably the most critical part of structuring a project finance deal. The mantra is simple: allocate risk to the party best able to manage it. Common risks and mitigants include: case reference. In the Mozambique LNG project, sponsors signed long-term LNG sales contracts before financial close, ensuring stable revenues. Political risk insurance was provided by MIGA World Bank Group, reducing lenders' concerns about government expropriation or breach of contract. 3. Special Purpose Vehicle (SPV) structure. The SPV is the legal entity that owns and operates the project. Ring fencing. The SPV's assets and liabilities are separate from the sponsors. Transparency. All cash flows are tracked and used first for project operations and debt service before profits are distributed. Control. Lenders often have direct control over key SPV decisions through covenants and step-in rights. This structure provides predictability, allowing financiers to monitor performance and intervene if needed. 4. Cash flow waterfall. The cash flow waterfall is a priority of payments mechanism that governs how every dollar earned by the project is allocated. Typical order: operating and maintenance costs, taxes and statutory dues, senior debt service, interest plus principal, reserve accounts, e.g., DSRA, debt service reserve account, mezzanine debt, if any, dividends to equity holders. This hierarchy ensures lenders get paid first, reducing their risk and lowering borrowing costs. 5. Transparency and covenants. Project finance relies on tight monitoring and contractual discipline. Financial covenants, e.g., maintaining DSCR above a threshold. Reporting requirements, quarterly financial statements, operational metrics. Restrictions on additional debt or asset sales without lender consent. These safeguards protect lenders and maintain project stability. 2.3 Essential financial metrics. Several financial ratios are crucial in assessing project bankability. Debt service coverage ratio, DSCR. DSCR equals cash available for debt service, CFADS debt service, principal plus interest. DSCR equals debt service, principal plus interest cash available for debt service, CFADS. DSCR greater than 1.2 is typical for infrastructure projects, higher for riskier sectors. Loan life coverage ratio, LLCR, measures NPV of CFADS over the loan life relative to debt outstanding. Project IRR and equity IRR gauge returns for sponsors and investors, guiding equity commitment decisions. 2.4 The role of contracts. Contracts are the backbone of project finance. They convert risks into quantifiable obligations. Concession agreement grants rights to build and operate, e.g., toll road concession. Offtake agreement ensures predictable revenues, PPAs, take-or-pay contracts. Supply agreement secures key inputs at stable prices, e.g., fuel supply. EPC contract transfers construction risk to the contractor. O&M contract guarantees long-term performance and reliability. Mini case: the Delhi Metro Rail project in India is a good example of contract-driven success. Through clear concession agreements, fixed-price EPC contracts, and availability-based payment mechanisms, the project achieved financial closure with support from JICA, Japan International Cooperation Agency, and commercial lenders. 2.5 The bankability checklist. Before lenders approve a deal, they typically assess whether the project is bankable, i.e., capable of attracting financing under reasonable terms. Key criteria include strong and creditworthy counterparties, predictable and reliable cash flows, balanced risk allocation, no party bears disproportionate risk, robust technical and environmental feasibility, adequate returns for equity investors. 2.6 Case study: Bujagali Hydroelectric Project, Uganda. Background: Uganda faced a severe power crisis in the early 2000s. The Bujagali Hydroelectric Project, 250 megawatts, became one of the most significant infrastructure projects in East Africa. Key concepts in action. SPV, Bujagali Energy Limited, was formed. Risk allocation. Construction risk passed to EPC contractor Salini. Offtake. 30-year power purchase agreement with Uganda Electricity Transmission Company Limited. Political risk mitigation. World Bank Group provided partial risk guarantees. Outcome: Financial close achieved in 2007. Project operational since 2012, significantly reducing power shortages. This project demonstrated how a robust combination of contracts, guarantees, and multilateral participation can de-risk an emerging market project and attract international lenders. 2.7 Conclusion. The principles of project finance, limited recourse, risk allocation, SPV structuring, cash flow discipline, and contractual rigor, are what make this financing method viable for complex, capital-intensive projects worldwide. These concepts are not academic theories. They are living, breathing practices that have been proven across hundreds of projects globally. The next chapter will explore the project development and feasibility process, where these principles first get applied to turn an idea into a bankable deal. Chapter 3: Market Landscape and Trends. 3.1 The Global Project Finance Market. Project finance is no longer a niche funding mechanism. It is now a multi-trillion-dollar global industry that fuels infrastructure development, energy transition, and technological expansion worldwide. According to leading industry reports, annual project finance debt volumes regularly exceed $350 billion, with infrastructure and energy projects dominating deal flow. 3.2 Evolution of the market. 1. Early period, pre-1980s. Project finance was mainly used in oil and gas projects and mining ventures, often backed by government guarantees or long-term offtake contracts. 2. Growth era, 1980s to 1990s. The rise of independent power producers, IPPs, and privatization of infrastructure created massive demand for project finance globally. The 1990s saw pioneering PPPs in transportation and utilities. 3. Modern era, 2000s present. Shift toward renewable energy, solar, wind, hydro. Increasing focus on climate resilience and sustainable finance. Greater participation of institutional investors, pension funds, sovereign wealth funds. Emergence of green bonds and sustainability-linked loans. 3.3 Regional Market Overview. The project finance market is not homogeneous. Regional dynamics significantly influence deal structures, risk profiles, and financing costs. 1. Europe. Strong tradition of public-private partnerships, PPPs, in transportation, healthcare, and social infrastructure. Leading market for renewable energy projects, particularly offshore wind. Mature financial ecosystem with deep debt and equity markets. Case example: the Dogger Bank Wind Farm, UK, the world's largest offshore wind project, achieved financial close with a mix of commercial banks, export credit agencies, and green bonds. Its multi-tranche financing structure demonstrates Europe's appetite for large-scale, low-carbon infrastructure. 2. North America. Highly active in LNG terminals, renewables, and digital infrastructure, data centers, fiber. PPP market is growing but still lags Europe in social infrastructure adoption. Institutional investors often participate through project bonds and tax equity financing. Case example: the Long Ridge Energy Terminal, Ohio, USA, a combined cycle power plant with hydrogen blending capability, was financed through a blend of commercial bank loans and institutional debt, reflecting the region's innovation in energy transition projects. 3. Asia Pacific. Fastest growing region for project finance, driven by infrastructure needs and rapid urbanization. Dominant sectors: power generation, transport, renewables, and ports. Governments play an active role, often providing guarantees or viability gap funding. Case example: Mumbai Metro Line 3, India, was structured as a hybrid PPP with government support and multilateral financing, enabling a major mass transit expansion despite high capital costs. 4. Latin America. Rich opportunities in renewable energy, transport concessions, and mining projects. Political and currency risk are significant factors. Deals often rely on multilateral lenders, IDB, CAF, for risk mitigation. Case example: the Ruta del Sol Highway Project, Colombia, was financed through project bonds and commercial loans, though later affected by governance and corruption issues, highlighting the importance of strong oversight and anti-corruption mechanisms. 5. Middle East and Africa. Dominated by oil and gas, petrochemical complexes, and increasingly solar and wind projects. Many projects rely on sovereign backing or offtake from state-owned entities. Political risk insurance and multilateral support are crucial. Case example: the Noor Ouarzazate Solar Complex, Morocco, one of the world's largest concentrated solar power plants, was financed with a mix of concessional loans, multilateral funding, World Bank AFDB, and private equity, setting a benchmark for large-scale renewable projects in Africa. 3.4 Sectoral trends. 1. Renewable energy boom. Solar PV and wind dominate new project finance deals. Falling technology costs and supportive policies, feed-in tariffs, auctions, have made renewables bankable even without subsidies. Growth of corporate PPAs, big tech firms, Google, Amazon, are contracting directly with renewable developers. 2. Energy transition and decarbonization. Rising investment in green hydrogen, carbon capture and storage, CCS, and battery storage projects. Emergence of sustainability-linked project financing, where loan pricing is tied to ESG performance. 3. Digital infrastructure. Surge in financing of data centers, subsea cables, and satellite constellations. Telecom operators and private equity funds are major investors. 4. Transportation and urban infrastructure. Growing adoption of availability-based PPPs, where government payments are tied to service availability rather than demand. Smart mobility projects, including electric vehicle EV charging networks, are entering the project finance space. 3.5 Market challenges. While the market is robust, there are persistent challenges. Rising interest rates increasing the cost of capital. Supply chain disruptions causing cost overruns in construction. Political risk in emerging markets, contract renegotiations, currency controls. ESG scrutiny. Lenders are increasingly selective, avoiding projects with negative environmental or social impact. 3.6 Future outlook. The project finance market is expected to grow significantly over the next decade, powered by global infrastructure gaps, estimated $15 trillion investment needed by 2040. Climate action commitments, net zero targets pushing massive renewable energy deployment. Blended finance models, combining public, private, and philanthropic capital to de-risk investments in developing economies. Digital transformation, financing of AI-ready data centers, 5G networks, and satellite internet constellations. 3.7 Conclusion. The global project finance market is dynamic, geographically diverse, and increasingly driven by sustainability imperatives. The coming decades will see unprecedented capital mobilization into infrastructure and energy transition, making project finance a critical enabler of economic development and decarbonization. Understanding regional nuances, sectoral trends, and emerging financing innovations is essential for professionals entering this field. In the next chapter, we will explore project development and feasibility studies, where market trends translate into actionable project opportunities. Chapter 4. Project Development and Feasibility. 4.1 From idea to bankable project. Every project begins as a concept, a solution to a need. It may be a toll road to reduce congestion, a power plant to meet rising electricity demand, or a solar farm to help a country meet its renewable energy targets. But not every idea is financeable. Lenders and investors require evidence that the project is technically viable. It is financially sustainable over its entire life cycle. Legal, regulatory, and environmental risks have been addressed. This evidence comes through a structured process of project development and feasibility assessment. 4.2 The project development cycle. Project development typically follows a multi-stage process. Conceptualization in screening. Identify the infrastructure gap or market opportunity. Conduct high-level demand assessment. Screen for political, legal, and regulatory viability. Pre-feasibility study. Preliminary technical design. Rough order of magnitude cost estimate. Early risk mapping and stakeholder engagement. Feasibility study, full scale. Technical feasibility, detailed engineering studies. Financial feasibility, cash flow modeling, IRR, DSCR calculations. Economic feasibility, cost-benefit analysis from a national or social perspective. Environmental and social impact assessment, ESIA, required by lenders and regulators. Bankability assessment. Optimize project structure, SPV, contracts, risk allocation. Secure offtake agreements, permits, and approvals. Prepare lender-ready documentation, information memorandum. Financial close and construction. Negotiate financing agreements with debt and equity providers. Reach financial close when funds are committed and available. Transition to construction phase under EPC contracts. 4.3 Technical feasibility. Technical feasibility answers the question: can the project be built and operated reliably for its intended life? Key steps include site selection, geotechnical surveys, resource availability, e.g., solar irradiation, wind speeds. Technology choice, proven versus emerging technologies. Lenders favor mature, bankable technologies with strong track records. Engineering studies, preliminary designs, cost estimates, construction schedule. Mini case: in a 100 megawatts wind farm project in Vietnam, developers used 5 years of wind speed data to confirm capacity factor assumptions before presenting the project to lenders. This data reduced uncertainty and improved debt terms. 4.4 Financial feasibility. A robust financial model is the heart of project feasibility. It should include capital expenditure, CapEx, EPC cost, contingencies, development costs. Operating expenditure, OPEX, O&M costs, insurance, land lease, staffing. Revenue forecasts, based on contracted offtake, tariffs, or projected demand. Funding structure, equity-debt ratio, interest rates, repayment profile. Key metrics: DSCR, debt service coverage ratio. IRR, internal rate of return. Payback period. Tip: lenders run their own sensitivity analyses, testing downside scenarios such as lower revenues, cost overruns, or delayed completion. A project that remains solvent under stress conditions is far more likely to secure financing. 4.5 Legal and regulatory feasibility. Legal feasibility ensures that the project has land rights, secure titles, leases, or concessions. Permits and licenses, construction permits, environmental approvals, grid interconnection agreements. Regulatory compliance, alignment with sector regulations and tariff frameworks. Case reference: the Kenya Lake Turkana wind power project faced years of delay due to transmission line right-of-way disputes. Legal feasibility checks, earlier in development, could have reduced risk exposure. 4.6 Environmental and social feasibility. Modern project finance deals cannot ignore ESG considerations. Most lenders follow IFC performance standards or Equator principles, requiring environmental and social impact assessment, ESIA, stakeholder consultation and grievance redress mechanisms, mitigation plans for biodiversity, resettlement, and community impact. Projects with poor ESG compliance risk losing financing or facing reputational backlash. 4.7 Risk mapping during development. A key part of feasibility is preparing a risk register, a living document mapping each major risk, its likelihood, impact, mitigation strategy, and risk owner. Example risk categories: construction risk, delay, cost overrun; market risk, demand shortfall; political risk, contract renegotiation, expropriation; environmental risk, permit rejection, public opposition. Best practice: update the risk register regularly throughout development and share it with potential financiers. A transparent risk management plan builds confidence. 4.8 Case study: Lake Turkana Wind Power Project, Kenya. Background: largest wind power project in Africa, 310 megawatts. Developed to harness strong wind resources near Lake Turkana. Feasibility process: extensive wind data collection over several years confirmed strong, consistent wind speeds. Detailed ESIA conducted with community engagement. Financing from a mix of DFIs, African Development Bank (AIB) and commercial banks. Challenges: transmission line delays meant power could not be evacuated after project completion, resulting in lost revenue and government compensation claims. Lessons learned: synchronize project development with associated infrastructure, e.g., transmission lines. Early coordination with government agencies can prevent bottlenecks. 4.9 Creating a bankability roadmap. Project sponsors should think like lenders and create a bankability roadmap early in the development phase. This document should outline key project assumptions, contractual framework, offtake, EPC, O&M, risk allocation and mitigation measures, required government support or guarantees, target debt-to-equity ratio, and funding sources. A clear roadmap accelerates lender due diligence and increases the chance of timely financial close. 4.10 Conclusion: project development and feasibility are where vision meets rigor. A technically sound idea that lacks proper feasibility analysis will not attract capital. Conversely, a well-developed project with strong data, robust contracts, and clear risk allocation becomes bankable, unlocking billions of dollars in financing. The next chapter will explore financial modeling in project finance, taking readers inside the spreadsheets where feasibility studies are converted into actionable funding decisions. Chapter 5: Financial Modeling for Project Finance. 5.1 Why Financial Modeling Matters. In project finance, numbers tell the story. The financial model is the single most important tool for sponsors, lenders, and investors to evaluate whether a project is viable, how risks affect returns, and whether financing terms can be supported by future cash flows. A project's model is used to size the debt, determine maximum borrowing capacity, calculate coverage ratios, DSCR, LLCR, PLCR, analyze returns for equity investors, equity IRR, conduct sensitivity and scenario analysis, provide lenders with a base case, downside case, and stress case forecast. Think of the model as the project's financial blueprint. Just as engineers use technical drawings to build a bridge, financiers use the model to structure debt and equity. 5.2 Structure of a project finance model. A well-built model follows a clear, logical structure that allows easy navigation and auditing. Typical model sections: assumptions, inputs, project start date, construction duration, operating period, CapEx, construction cost, contingencies, operating costs, fixed plus variable, financing terms, interest rates, debt tenor, repayment profile, revenue assumptions, tariffs, offtake volume, escalation, tax, inflation, and foreign exchange assumptions, construction phase calculations, sources and uses of funds table, drawdown schedule for equity and debt, interest during construction, IDC, operating phase calculations. Revenue projections. O&M and other operating costs. Working capital adjustments. Depreciation and tax calculations. Financing and debt service. Debt drawdown schedule. Principal plus interest repayment schedule, amortization. Reserve accounts, debt service reserve account, DSRA. Cash flow waterfall. Cash available for debt service, CFADS. Debt service, interest plus principal. Residual cash for equity distributions. Outputs, KPIs. DSCR, LLCR, PLCR. Equity IRR, project IRR, NPV. Payback period. 5.3 key metrics and formulas. 1. Debt service coverage ratio, DSCR. DSCR equals CFADS debt service, interest plus principal. DSCR equals debt service, interest plus principal CFADS. Example. CFADS equals $12 million. Annual debt service equals $10 million. DSCR equals 1.20, healthy coverage. Best practice. Lenders typically require a minimum DSCR, e.g., 1.2x for contracted projects, 1.4x plus for merchant risk projects. 2. Loan life coverage ratio, LLCR. LLCR equals NPV of CFADS over loan life, discounted at WACC. Outstanding debt. LLCR equals outstanding debt NPV of CFADS over loan life, discounted at WACC. Measures the ability of the project to cover debt over its entire life. 3. Project and equity, IRR. Project IRR, based on total project cash flows before financing. Equity IRR, based on cash flows after debt service, measuring sponsor returns. 5.4 Example, simple base case model. Imagine a 50 megawatts solar power plant. CapEx, $50 million. Debt, $35 million, 10-year term, 6% interest. Tariff, 7 cents per kWh, output, 100 gigawatt hours per year. O&M costs, $3 million per year. Base case DSCR calculation. This base case shows the project meets the minimum DSCR of 1.2x, meaning it can support the proposed debt sizing. 5.5 Sensitivity and scenario analysis. Lenders will stress test the model under different scenarios. Downside case, 10% lower revenues, 10% higher O&M costs. Construction delay, 6-month delay, additional interest during construction. FX shock, 15% currency depreciation for projects with FX exposure. Objective: ensure the project remains solvent and debt service is covered even under adverse conditions. 5.6 Best practices for model design. Transparency, clearly separate inputs, calculations, and outputs. Flexibility, allow users to change assumptions easily. Auditability, avoid hard-coding numbers, use consistent formulas. Documentation, include a user guide tab for stakeholders. Error checks, build automated flags for negative cash flows, covenant breaches, or insufficient DSCR. 5.7 Case study, the Thames Tideway Tunnel, UK. Background: the Thames Tideway Tunnel is a £4.2 billion project to upgrade London's sewer system. Financial model highlights. Complex model with over 20,000 rows, integrating construction cost forecasts, regulatory revenue allowances, and financing structure. Extensive sensitivity analysis, including inflation risk and demand risk, usage volumes. Used to secure over £3 billion in debt financing, including green bonds and EIB funding. Lesson learned: well-structured financial models can give comfort to investors and regulators, even in complex multi-decade projects. 5.8 Role of independent model auditors. Before financial close, lenders often engage independent model auditors to check calculations for accuracy, validate consistency with contracts, Ensure outputs reflect assumptions correctly. A model audit can reveal errors that would otherwise threaten financial close. 5.9 Conclusion. Financial modeling is the nerve center of project finance. It transforms engineering designs and commercial contracts into numbers that investors and lenders can rely on. A robust, transparent model not only facilitates financial close, but also serves as a monitoring tool throughout the project's life. In the next chapter, we will discuss risk identification and allocation, diving deeper into how risks are systematically analyzed and allocated through contracts, a cornerstone of making projects bankable. Chapter 6: Risk Identification and Allocation. 6.1 The central role of risk in project finance. At its heart, project finance is about structuring and allocating risk. Lenders do not rely on the sponsor's balance sheet, they rely on the project itself. This means every foreseeable risk must be identified, systematically mapped during development, allocated, assigned to the party best able to manage it, mitigated, through contracts, guarantees, or insurance, priced, reflected in financing terms and equity return expectations. Failure to manage risk effectively can derail financing or cause project default post-construction. 6.2 The risk identification process. A risk register is usually prepared during the feasibility stage. It lists risk description, e.g., cost overrun, interest rate spike, probability, high, medium, low, impact, financial, schedule, reputational, mitigation measures, contractual or financial, risk owner, SPV, contractor, lender, government, insurer. This becomes a living document updated until financial close and used by lenders in due diligence. 6.3 Major categories of risk. Let's examine the key risk types common to most project finance transactions. 1. Construction risk. Definition: risk that the project is not completed on time, on budget, or to specification. Mitigants: EPC contract, fixed price, date certain, turnkey contract with performance guarantees and liquidated damages. Parent guarantees: EPC contractor's parent company provides support. Contingency reserve, built into CapEx to absorb overruns. Example: for the Shuweihat S2 IWPP UAE, a fixed-price EPC contract was signed with an experienced international contractor. Liquidated damages clauses protected the SPV from revenue losses due to delays. 2. Supply and resource risk. Relevant for projects dependent on fuel, water, or raw materials. Mitigants: long-term fuel supply agreements with price indexation. Diversified supply sources. Hedging instruments for commodity price volatility. 3. Market demand risk. Definition: risk that the project's revenues fall short due to lower than expected demand or price fluctuations. Mitigants: take or pay offtake agreements. Buyer commits to pay even if they do not take delivery, common in LNG power projects. Government support, minimum revenue guarantees. Availability-based payments. In PPPs, government pays based on facility availability, not traffic volumes. Example: the Autopista del Sol toll road in Chile suffered traffic shortfalls during economic downturns. Subsequent PPP contracts in the country used minimum revenue guarantees to mitigate demand risk for lenders. 4. Operational risk. Risk of underperformance or higher than expected operating costs once the project is operational. Mitigants: long-term O&M contract with performance incentives, penalties. Warranty periods for major equipment. Insurance, business interruption, machinery breakdown. 5. Political and regulatory risk. Especially relevant in emerging markets. Risks include expropriation, tariff freezes, contract renegotiation, or currency controls. Mitigants: Political risk insurance, PRI, provided by MIGA private insurers. Multilateral participation. Presence of World Bank DFIs creates deterrent against government interference. Stabilization clauses. Contract clauses protecting against adverse legal regulatory changes. Example: in the Quezon Power Project, Philippines, World Bank's IFC participation was critical in giving lenders comfort that the government would honor the PPA over its 25-year term. 6. Foreign exchange, FX risk. For projects with foreign currency debt, but local currency revenues. Mitigants. Natural hedging, e.g., revenues partially in USD. Financial hedging, forward swaps. Government guarantees of convertibility. 7. Force majeure and climate risk. Natural disasters, pandemics, or climate-related events that disrupt operations. Mitigants. Force majeure clauses in contracts, time relief not always cost. Comprehensive insurance coverage. Climate-resilient design, e.g., higher seawalls for coastal infrastructure. 6.4 Risk allocation matrix. 6.5 Risk pricing. Not all risks can be eliminated, some must simply be priced into the transaction. Higher equity IRR. Sponsors demand higher returns for taking market risk. Higher DSCR. Lenders may require higher coverage ratios for volatile cash flows. Interest rate premium. Lenders price in political or currency risk. This is why risk allocation is critical. Shifting risk to the party best positioned to manage it often lowers financing costs. 6.6 Case study, Mozambique LNG project. Background: one of Africa's largest LNG developments, with $20 billion capex. Risk allocation highlights. Construction risk, transferred to EPC consortium with strong performance guarantees. Market risk, mitigated via 20-year LNG sales contracts with creditworthy buyers. Political risk, backed by political risk insurance from MIGA and export credit agencies. Security risk, additional arrangements with government due to insurgent activity in Cabo Delgado region. Outcome: despite delays due to security challenges, the project's risk allocation and multilateral involvement enabled one of the largest ever project financings in Africa. 6.7 Lessons learned. Early risk identification prevents surprises later in development. Balanced allocation ensures no single party is overburdened. Unbalanced risks can make a project unbankable. Contractual discipline is essential. Vague risk allocation leads to disputes. Multilateral involvement can unlock financing in high-risk jurisdictions. 6.8 Conclusion. Risk management is not about eliminating risk, it is about distributing it efficiently. A project becomes bankable when risks are predictable, quantified, and contractually allocated. The next chapter will examine project contracts and legal frameworks, where these risk allocations are codified into legally binding agreements. Chapter 7: Project Contracts and Legal Framework. 7.1 Why Contracts Matter. In project finance, contracts are the foundation of risk allocation. Unlike corporate finance, where lenders rely on the sponsor's balance sheet, project lenders rely on the project's contractual ecosystem to ensure predictable construction, operation, and cash flows. Clearly defined rights and obligations of each party. Legal remedies if something goes wrong. Well-structured contracts give confidence to lenders, reduce financing costs, and align the interests of all participants. 7.2 The contractual web in project finance. A project finance deal is often visualized as a contractual nexus surrounding the special purpose vehicle, SPV. At the center sits the SPV, connected to a network of contracts that define every major risk. Construction contract, EPC. Offtake agreement, PPA, toll concession, take-or-pay contract. Supply agreements, fuel, raw materials. Operation in maintenance, O&M agreement. Shareholders agreement. Financing agreements, loan security documents, intercreditor. Government support agreements, if applicable. Insurance policies. 7.3 Key project contracts. Let's go through each of these in detail. 1. Engineering, procurement, and construction, EPC contract. Purpose: manages construction risk by appointing a contractor to design, build, and deliver the project on a turnkey basis. Key features: fixed price, contractor bears cost overrun risk. Date certain, guaranteed completion date with liquidated damages, LDs for delays. Performance guarantees, output efficiency or availability guarantees. Defect liability period, post-completion period where contractor must rectify defects. Case example: in the Qatar Rosgas LNG project, EPC contracts were structured with stringent LD clauses and backed by parent company guarantees, giving lenders confidence in timely completion. 2. Offtake agreement, revenue contract. Ensures predictable revenues, the lifeblood of project finance. Types of offtake agreements. Power purchase agreement, PPA. Buyer commits to purchase electricity at a fixed tariffed rate for 15 to 25 years. Take-or-pay agreement. Buyer pays for a minimum quantity whether or not they take delivery, common in LNG. Availability-based payment mechanism. In PPPs, government pays based on service availability rather than demand. Key clauses. Tenor usually matches debt maturity. Payment terms and tariff indexation. Termination rights and compensation formula. Force majeure provisions. 3. Supply agreements. Secure long-term access to key inputs, fuel, feedstock, water. Price indexation. Links input cost to market indices. Security of supply. Dedicated pipeline or delivery commitments. 4. Operation and maintenance, O&M agreement. Ensures long-term operational performance and cost predictability. Key provisions. Operator's scope of work and performance KPIs. Penalties for underperformance, availability deductions. Term and renewal options. Mini case. In the Bujagali hydropower project, Uganda, the O&M agreement included a long-term availability guarantee, assuring lenders of stable cash flows during the debt repayment period. 5. Shareholders Agreement, SHA. Governs the relationship between sponsors, investors in the SPV. Key aspects. Equity contribution commitments. Dividend distribution policy. Governance and voting rights. Transfer restrictions and exit provisions. 6. Financing agreements. The legal backbone of lender-SPV relationship, including Common Terms Agreement, sets out rights, covenants, and obligations. Loan Agreement, specifies interest rate, tenor, repayment schedule. Security Documents, pledges over project assets, shares, bank accounts. Intercreditor Agreement, manages priorities between multiple lender classes. 7. Government support agreements. Especially relevant in emerging markets and PPPs. Forms of support. Sovereign guarantees of off-taker payments. Viability gap funding, VGF, to improve economics. Step-in rights allowing lenders to take control in case of default. 8. Insurance policies. Provide coverage against major risks. Construction all-risk car insurance. Delay in startup, DSU insurance. Property damage, business interruption insurance. Political risk and terrorism insurance. 7.4 Legal framework considerations. Even with robust contracts, the legal environment matters. Enforceability. Can contracts be enforced in local courts or arbitration forums? Security perfection. Are lender security interests legally recognized and enforceable? Permits and licenses. Are all regulatory approvals in place and transferable? Dispute resolution. Is there an agreed mechanism, local courts, ICC arbitration, ICSID arbitration? Best practice. Use international arbitration clauses, e.g. LCIA, ICC, to avoid uncertainty in jurisdictions with weaker legal systems. 7.5 Contractual risk allocation in practice. Contracts formalize risk allocation. Construction risk right-pointing arrow EPC contractor. Market risk right-pointing arrow off-taker government. O&M risk right-pointing arrow operator. Political risk right-pointing arrow mitigated through government agreements or multilateral guarantees. A well-drafted contractual package creates bankability, giving lenders comfort that cash flows are secure. 7.6 Case study. Delhi International Airport PPP. Background. One of India's largest PPPs, modernizing Delhi Airport. Contractual highlights. Concession agreement with 30-year term. Revenue sharing mechanism with government. EPC contracts with LDs for timely completion. Government support agreement, ensuring land and regulatory clearances. Outcome. The contractual framework attracted both domestic and international lenders, leading to successful financial close and timely project completion. 7.7 Lessons learned. Consistency across contracts. All agreements must align. A mismatch can create unbankability. Clear termination provisions. Lenders need to know what happens if contracts are terminated early. Strong step-in rights. Allow lenders to replace non-performing operators or contractors. Legal opinions. Independent counsel must confirm enforceability under relevant law. 7.8 Conclusion. Contracts transform theoretical risk allocation into enforceable commitments. A project with poorly drafted or unbalanced contracts may never reach financial close, regardless of technical or economic merit. In the next chapter, we will explore financing structures, breaking down the debt and equity instruments used to fund these projects and how they are layered into the capital stack. Chapter 8. Debt instruments and lender perspectives. 8.1 The role of debt in project finance. Debt is the dominant component of most project finance capital structures, often 60 to 80% of total funding. Using debt enhances equity returns through leverage, but it also increases financial risk, hence the importance of structuring it carefully to match project cash flows. Debt in project finance is typically non-recourse or limited recourse. Lenders rely on project cash flows and security package, not sponsor balance sheet. Cash flow based. Repayment is linked to project's ability to generate CFADS, cash flow available for debt service. Long tenor. Matches the life of the underlying asset, often 10 to 20 years. 8.2 Types of debt instruments. Let's break down the main forms of debt used in project finance. 1. Commercial bank loans. Structure. Senior secured term loans provided by one or several banks. Tenor. 5 to 15 years, sometimes longer in developed markets. Pricing. Floating rate, LIBOR SOFR plus margin, though fixed rates can be hedged. Repayment. Sculpted amortization to match projected CFADS. Example. Most renewable energy projects in Europe are financed by syndicates of commercial banks offering long tenor fixed price loans with DSCR covenants. 2. Syndicated loans. Large projects often require more debt than a single bank is willing to provide. Lead arranger structures the deal and invites other banks. Loan agreement. Single set of terms for all lenders. Benefits. Risk diversification, larger ticket size, unified documentation. 3. Development Finance Institution (DFI) loans. Institutions like the IFC, AFDB, ADB, I provide. Long tenor debt, 15 to 20 plus years. Political risk comfort. Their presence deters expropriation or regulatory interference. Sometimes concessional terms, lower interest rates. Case. The IFC and African Development Bank jointly financed the Lake Turkana wind project in Kenya, providing long-tenor debt that commercial banks were unwilling to extend due to perceived political risk. 4. Export Credit Agency (ECA) financing. ECAs, e.g. US Exim, JBIC, Euler Hermes, support exports from their home countries by providing direct loans to the project SPV, guarantees, covering commercial banks' exposure, often used for projects with significant imported equipment. Tenor can be very long, up to 18 years OECD compliant. 5. Project bonds. Definition: bonds issued by the SPV to institutional investors. Tenor: often very long, 20 to 30 years. Advantages: fixed interest rate, access to large pools of capital, pension funds, insurers. Challenges: require investment-grade credit rating and a completed construction phase or credit enhancement. Case example: the Indiana Toll Road refinancing used project bonds to replace bank debt, lowering overall cost of capital and locking in long-term fixed rates. 6. Mezzanine debt, subordinated debt. Sits between senior debt and equity in the capital stack. Higher interest rate reflects higher risk. Can be structured as subordinated loans, preferred equity, convertible debt. Used to fill the funding gap when senior debt capacity is maxed out. 8.3 Debt sizing and sculpting. Debt sizing determines how much the project can borrow without breaching lender coverage requirements. Key metrics: DSCR, minimum typically 1.20 to 1.40x depending on risk. LLCR, loan life coverage ratio, should exceed lender's threshold, e.g. 1.3x. Debt sculpting, adjusting principal repayment so that coverage ratios are consistent over time. Larger repayments when cash flows are strong. Smaller repayments in weaker years. 8.4 Lender perspectives. Lenders focus on predictability and downside protection. Key concerns: technical: is the project technically sound and feasible? Commercial: are offtake and supply contracts robust and bankable? Legal: are contracts enforceable, security interests perfected? Financial: does the model show sufficient DSCR even under downside cases? Sponsor strength: do sponsors have track record and skin in the game? 8.5 Security package. To mitigate risk, lenders take a comprehensive security package including pledge over SPV shares, assignment of key contracts, EPC, PPA, O&M, charge over project accounts, including DSRA, debt service reserve account, mortgage over physical assets. 8.6 Covenants and lender controls. Lenders impose covenants to protect themselves. Financial covenants: maintain minimum DSCR, restrict dividend payments until ratios are met. Information covenants: regular reporting, monthly, quarterly financials. Negative covenants: restrictions on additional debt, asset sales, or changes to key contracts without lender consent. Step-in rights: right to replace operator or take control if SPV defaults. 8.7 Case study: Nacala Corridor Railway and Port Project, Mozambique, Malawi. Financing structure: total cost $4.5 billion. Debt: $2.7 billion from commercial banks, ECAs, DFAs. Tenor: 14 years average maturity. Security package: mortgages over assets, assignment of port tariffs and rail access charges. Lender perspective: concern about political risk, right pointing arrow mitigated by ECA guarantees and multilateral involvement. Structured to withstand commodity price downturns via conservative volume forecasts. Outcome: despite challenging environment, the project achieved financial close, one of the largest cross-border financings in Africa. 8.8 Lessons learned. Right mix of debt instruments, combining commercial banks, DFIs and ECAs, can optimize tenor, pricing and risk mitigation. Balanced leverage. Over-leveraging may make project fragile under stress scenarios. Lender confidence equals lower cost of capital. Strong contractual structure and robust financial model translate into better pricing. Post-construction refinancing. Consider project bonds or cheaper debt once risks are reduced. 8.9 Conclusion. Debt financing is the engine that makes large-scale projects feasible. Understanding the variety of instruments, their risk appetites, and how to structure coverage ratios is essential for sponsors and developers. In the next chapter, we will explore equity and sponsor considerations, understanding the other side of the capital structure, how sponsors view returns, and how they negotiate with lenders to protect upside potential. Chapter 9: Equity and Sponsor Considerations. 9.1 The role of equity in project finance. Equity is the risk capital in a project. Sponsors provide equity to demonstrate commitment, skin in the game, cover costs that debt cannot finance, typically 20 to 40% of total project cost, absorb first losses if the project underperforms. Because equity is subordinated to debt, it carries the highest risk, but also the highest potential return. 9.2 Types of equity investors. Strategic sponsors. Industry players, utilities, infrastructure developers, oil and gas majors. Seek both financial returns and strategic value, market entry, supply security. Financial investors. Private equity funds, infrastructure funds, pension funds. Purely return-driven, may exit once the project is operational and de-risked. Public-private partnerships, PPP equity. Mix of private sponsors and government equity participation. Government equity signals commitment and aligns public-private interests. 9.3 Forms of equity. Equity can be structured in several ways. Ordinary shares, full voting rights, residual claim on cash flows. Preferred shares, priority dividend rights but limited voting rights. Shareholder loans, quasi-equity. Subordinated debt instruments treated as equity by senior lenders, often with PIK payment-in-kind interest. Convertible instruments. Convert into equity upon meeting certain conditions. Tip: quasi-equity can improve IRR while still being considered equity for lender leverage tests. 9.4 Equity contribution and timing. Equity is usually contributed first during construction before debt drawdowns or pro rata alongside debt, but with strict equity cure rights to ensure completion. Lenders insist on a minimum equity lock-in period and restrictions on dividend payments until certain ratios are met, DSCR LLCR. 9.5 Return metrics for equity investors. Equity investors focus on equity IRR, internal rate of return, annualized return on invested equity. Payback period, years to recover initial equity. Equity NPV, net present value of cash flows to equity. Target IRRs vary widely. 9.6 Sponsor risk and commitments. Lenders expect sponsors to have substantial commitment. Minimum equity contribution, typically 20 to 30% of total project cost. Completion guarantees. Sponsors may guarantee cost overruns until completion. Support agreements, to inject funds if DSCR falls below threshold, equity cure. This ensures sponsors are financially motivated to deliver the project successfully. 9.7 Dividend policy and cash flow waterfall. Cash flow distribution follows a strict waterfall. Operating expenses. Debt service senior first, then subordinated. Reserve accounts, DSRA replenishment. Dividends to shareholders. Restricted payments covenant. Lenders allow dividends only if no default is continuing. DSCR meets minimum requirement, e.g. is greater than or equal to 1.20x in last 12 months. Reserve accounts are fully funded. 9.8 Negotiating with lenders. Sponsors aim to maximize leverage to enhance equity IRR, but lenders push for conservative debt sizing. The negotiation focuses on DSCR levels. Sponsors push for lower DSCR, more debt. Lenders push for higher DSCR, safer. Tenor. Longer tenor improves equity IRR but increases lender exposure. Reserve requirements. Sponsors may resist overfunding reserves that trap cash. 9.9 Exit strategies for sponsors. Financial investors often plan their exit after de-risking. Sale of equity stake to infrastructure funds, pension funds, or strategic buyers. Refinancing. Replacing expensive construction debt with cheaper long-term bonds, releasing equity through dividends. IPO. Rare but possible for large infrastructure portfolios, yieldco model. Case example. Many wind and solar developers sell operational assets to listed yieldcos, recycling capital for new development. 9.10 Case study. I-595 Express PPP, Florida, USA. Overview. $1.8 billion PPP to upgrade a major highway corridor. Equity. $200 million from private consortium, Axe Infrastructure Dragados. Sponsor considerations. 35-year concession ensured long-term cash flows. Availability payments from state of Florida, reduced revenue risk. Equity IRR estimated at -11% with conservative traffic assumptions. Outcome. Project reached financial close with a combination of equity, bank debt, and federal TIFIA loan. Sponsors refinanced after construction to improve returns. 9.11 Lessons learned. Right-sizing equity. Too little equity, right-pointing arrow, unbankable project. Too much right-pointing arrow, diluted returns. Aligning interests. Equity cure rights and completion guarantees keep sponsors committed. Long-term value creation. Equity investors should plan exit strategy early. Transparent waterfall. Clear dividend policy avoids disputes and improves lender confidence. 9.12 Conclusion. Equity is the foundation of the project's capital stack and the ultimate risk bearer. Sponsors must balance risk, return, and leverage carefully to achieve a bankable structure while maximizing equity IRR. In the next chapter, we'll explore alternative financing structures, including project bonds, green finance, Islamic finance, SUCEC, and blended finance models that are shaping the future of infrastructure funding. Chapter 10. Alternative financing structures. 10.1 Why alternative structures matter. Traditional bank loans are not always sufficient or optimal for large, complex, or high-risk projects. Alternative financing structures help access new pools of capital, institutional investors, capital markets. Reduce funding costs, e.g. fixed-rate project bonds. Improve risk allocation, using guarantees or concessional finance. Enable projects in challenging markets, where commercial banks are reluctant. 10.2 Project bonds. Definition. Debt securities issued by the project SPV directly to capital market investors, pension funds, insurers. Key features. Long tenor, 15 to 30 years, ideal for long-lived assets. Fixed coupon, protects against interest rate volatility. Public or private placement, can be widely distributed or sold to select investors. Benefits. Unlocks large institutional capital pools. Potentially lower all-in cost of capital after construction completion. Challenges. Requires credit rating, investment grade preferred. Higher transaction cost, disclosure due diligence. Investors typically prefer operational projects, post-construction. Case example. The Autopista del Sol toll road in Chile issued project bonds to refinance construction debt, locking in long-term funding at lower interest rates. 10.3 Green finance and sustainability-linked loans. Growing demand for ESG-aligned investments has led to green bonds, proceeds earmarked for environmentally beneficial projects, renewables, energy efficiency. Sustainability-linked loans, SLLs, Loan pricing tied to ESG KPIs, e.g., emissions reduction, energy efficiency targets. Benefits: access to dedicated ESG capital. Potential pricing benefit: greenium. Enhanced reputation and stakeholder support. Example: Iberdrola and Ørsted have issued billions in green bonds to fund renewable energy portfolios, attracting ESG-focused institutional investors. 10.4 Islamic finance (Sukuk). Definition: Sharia-compliant financing structure where interest (riba) is prohibited. Instead, investors share in asset ownership or project revenues. Key instruments: Ijara lease-based. SPV leases project assets to offtaker, investors receive rent payments. Murabaha, cost plus sale. Bank buys assets and sells to SPV on deferred payment terms. Istisna, construction finance. Used for manufacturing production during construction. Sukuk, Islamic bonds. Represent fractional ownership of assets and entitlement to profits. Benefits: access to deep pools of Middle Eastern and Malaysian capital. Attractive for projects in Islamic countries. Challenges: complex structuring to ensure Sharia compliance. Requires approval by Sharia boards. Case example: the Sadara chemical project in Saudi Arabia used Sukuk financing as part of its $20 billion capital structure, attracting local investors and ensuring alignment with Sharia principles. 10.5 Blended finance. Definition: the strategic use of concessional capital from public or philanthropic sources to mobilize private sector investment. Tools: first loss capital. Public investors absorb initial losses, de-risking private capital. Guarantees: cover political risk, currency convertibility, or partial credit risk. Subordinated tranches: DFIs take junior debt positions to enhance senior debt credit profile. Benefits: enables bankability for projects in fragile or low-income countries. Crowds in commercial capital that otherwise would not participate. Example: the Lake Turkana Wind Project, Kenya, used concessional financing from the African Development Bank and partial risk guarantees from the World Bank to mobilize private debt and equity. 10.6 Hybrid structures and innovative approaches. Mini-perms, short to medium-term bank loans 5 to 7 years, with expectation of refinancing once project is operational. Halka financings, debt raised at holding company level secured by dividends from multiple projects. Portfolio financings, bundling several small projects into a single financing package, common in solar PV. Revenue indexed instruments, debt service adjusts based on revenue performance, aligning risk sharing between lenders and sponsors. 10.7 Credit enhancement tools. To make alternative structures attractive, projects often use credit enhancement. Multilateral guarantees, MEGA political risk cover, IB guarantees. Partial credit guarantees, provided by DFIs to raise credit rating of project bonds. Monoline insurance, wraps project bonds to achieve AAA rating, more common pre-2008 crisis, still used selectively. 10.8 Case study, Denver Eagle P3 commuter rail project. Overview: $2.2 billion rail project, financed using a mix of $398 million private activity bonds, PABs, $1.03 billion federal TIFIA loan, $450 million equity contribution. Highlights: innovative use of PABs, attracted institutional investors. Federal credit support improved bond rating and lowered coupon. Resulted in successful financial close and operational launch. 10.9 Lessons learned. Capital market solutions work best post-construction. Project bonds thrive once construction risk is eliminated. Green and ESG-linked finance growing rapidly. Sponsors should design projects to meet ESG criteria early. Blended finance unlocks difficult projects, especially in frontier markets or SDG-related sectors. Sharia-compliant finance expands investor base, essential for projects in Islamic jurisdictions. 10.10 Conclusion. Alternative financing structures provide flexibility, broaden investor participation, and can materially reduce the cost of capital. The ability to combine commercial debt, capital markets instruments, concessional capital, and innovative credit enhancements is a key differentiator for sophisticated sponsors. In the next chapter, we shift focus to risk management and governance, examining how insurance, monitoring, and ESG compliance play a continuing role after financial close. Chapter 11: Insurance in Project Finance. 11.1 The role of insurance. In project finance, insurance acts as a risk transfer mechanism, shifting certain risks from the SPV and its lenders to insurers. This ensures that even if catastrophic events occur, project cash flows can recover, debt can be serviced, and equity value is preserved. Insurance is especially critical because project financing is highly leveraged, 60 to 80% debt. Lenders have no recourse to sponsors, they rely solely on project cash flow. Force majeure events or asset losses can cause defaults if not insured. 11.2 Key Principles of Project Insurance. Comprehensive coverage. All insurable risks should be covered. Lender protection. Lenders are named as additional insureds and loss payees. Appropriate limits. Coverage limits must reflect replacement cost, not just book value. Compliance. Policies must comply with loan agreement requirements checked by insurance advisors. 11.3 Insurance during construction phase. Construction is the riskiest phase of a project. The insurance package typically includes: example, during the Bujagali hydropower project construction in Uganda, DSU insurance was critical when flooding delayed turbine installation. The payout covered debt service during the delay period. 11.4 Insurance during operations. Once the project is operational, coverage shifts focus from construction risks to operational continuity. 11.5 Specialized coverage. Political risk insurance, PRI, covers expropriation, currency inconvertibility, political violence. Providers: MIGA, OPIC, DFC, private insurers. Terrorism and sabotage, important for assets in high-risk regions. Natural catastrophe CAT coverage, earthquake, flood, hurricane, particularly for projects in vulnerable geographies. Cyber risk insurance, increasingly relevant for digital infrastructure and control systems. 11.6 Lender requirements. Loan agreements specify minimum insurance requirements. Typical provisions include: endorsements, lenders named as co-insured and first loss payee. Notice of cancellation, insurer must notify lenders before cancellation. Assignment, policies assigned to lenders as security. Insurance advisor opinion, independent advisor certifies adequacy of coverage. 11.7 Premium allocation and economics. Insurance premiums are usually treated as pre-financial close, part of development and financing cost. During construction, capitalized into project cost. During operations, operating expense included in O&M budget. 11.8 Case study, Sakhalin-2 LNG project, Russia. Background: a $20 billion LNG project in a seismically active and environmentally sensitive region. Insurance program highlights: car and ear policies covering multi-year construction phase. DSU coverage for several $billion of potential revenue loss. Environmental liability insurance due to sensitive marine ecosystem. PRI coverage due to geopolitical risk and foreign investment exposure. Outcome: despite severe storms and technical challenges, the insurance program provided comfort to lenders and paid out for several storm-related incidents without jeopardizing debt service. 11.9 Best practices. Early engagement. Appoint insurance advisor early in development to design bankable program. Tailored coverage, avoid generic policies. Coverage must match project risk profile. Monitor and update. Coverage must evolve with project phase and inflation. Claims management plan. Pre-agreed process for quick claim settlement to protect cash flows. 11.10 Lessons learned. Underinsurance is a deal breaker. Lenders will not fund without adequate coverage. DSU/BI coverage is crucial. Protects CFADS during force majeure events. Coordination is key. Policies must align with EPC and O&M contracts to avoid coverage gaps. Multilateral involvement helps. PRI from MEGA DFC can unlock financing in high-risk jurisdictions. 11.11 Conclusion. Insurance is a cornerstone of project finance risk management, ensuring that catastrophic events do not jeopardize lender repayment or sponsor returns. A carefully designed insurance program can significantly improve project bankability and reduce financing costs. In the next chapter, we will discuss political and regulatory risk management, taking a deeper look at government agreements, stabilization clauses, and the role of multilateral development institutions in de-risking projects. Chapter 12: Political and Regulatory Risk Management. 12.1 Understanding political and regulatory risks. Political and regulatory risks arise when government actions or inactions threaten a project's ability to generate expected cash flows. These risks are often outside the control of the SPV, making them particularly concerning for lenders. Key categories of political regulatory risk: expropriation, nationalization, government seizing project assets; breach of contract, government or SOE failing to honor concession PPA terms; tariff price changes, regulatory bodies revising tariffs, undermining project economics; currency inconvertibility, transfer restrictions, limiting ability to repatriate earnings; political violence, war, terrorism, civil unrest disrupting operations; permit revocation or delay, government withholding necessary licenses or environmental permits; change in law, new taxes, labor laws, or environmental regulations impacting costs. 12.2 Allocation of political risk. In project finance, political risk is ideally allocated to the party best able to manage it. Government provides guarantees, undertakes tariff commitments, ensures regulatory stability. Sponsors accept certain risks where mitigation is impractical or too costly. Lenders, multilaterals, provide risk cover through political risk insurance or guarantees. 12.3 Government support mechanisms. To make projects bankable, host governments often provide government guarantees, cover obligations of state-owned offtakers, e.g., PPAs, concession payments; sovereign support letters, assurance of non-interference or support in case of contract breach; stabilization clauses, protect investors from adverse changes in law or taxes; step-in rights, allow lenders to take over project management in case of default; currency hedging or guarantees, commit to making foreign currency available for debt service. Example: in the Tanjung Ben Energy Coal Project, Malaysia, government guarantees backed the offtaker's PPA obligations, making the project financeable. 12.4 Role of multilateral development banks, MDBs. MDBs like the World Bank Group, EBRD, AFDB, ADB and IFC play a critical role. Provide partial risk guarantees, PRGs, and partial credit guarantees, PCGs. Offer political risk insurance via MEGA for expropriation, breach of contract, currency issues. Enhance credit ratings and mobilize private financing by reducing perceived country risk. 12.5 Contractual protections. 1. Concession agreements and PPAs. Include termination compensation clauses if government terminates contract without cause. Tariff adjustment mechanisms, e.g., pass-through of fuel price or inflation. 2. Change in law clauses. Provide compensation for increased costs or reduced revenues caused by regulatory changes. May distinguish between discriminatory, targeted, and general, affecting all industries laws. 3. Dispute resolution. International arbitration under ICSID or UNCITRAL rules to avoid local court bias. 12.6 Political risk insurance, PRI. Coverage. Expropriation. Breach of contract. Currency inconvertibility. Political violence. Providers. MEGA World Bank Group, long tenor PRI for up to 20 years. DFC US, PRI for U.S. investors abroad. Private insurers, Lloyd's Market, Zurich Chubb. Benefit. PRI payout typically covers outstanding debt, thus protecting lenders and ensuring continued project viability. 12.7 Currency risk and mitigation. Currency risk is one of the most common political economic risks in cross-border projects. Currency hedging. For projects with revenues in local currency but debt in hard currency. Local currency financing. Use of domestic banks or MDB local currency facilities. Indexation. Tariffs indexed to USD or CPI to maintain real value. 12.8 Regulatory risk management. Projects in regulated sectors, power, water, transport, face ongoing exposure to tariff resets. Regulatory approvals for expansions. Policy changes on subsidies or renewable incentives. Mitigation. Long-term regulatory agreements with clear tariff formulas. Independent regulator oversight, rather than political ministries. Regular consultation mechanisms with stakeholders. 12.9 Case study, Dabhol Power Project, India. Background. Enron-led project to build a $3 billion LNG-fired power plant in the 1990s. Political risk issues. State utility MSEB stopped buying power due to tariff disputes. Political backlash against perceived unfavorable contract terms. Project faced arbitration but ultimately collapsed. Lessons learned. Importance of political alignment and stakeholder engagement early in development. Need for robust government guarantees and termination compensation clauses. MDB involvement could have improved credibility and negotiation balance. 12.10 Case study, Bujagali Hydropower Project, Uganda. Positive example. Government provided sovereign guarantees backing off-taker obligations. World Bank and AFDB provided PRGs, reducing political risk premium. Project reached financial close, despite Uganda's challenging investment climate. 12.11 Lessons learned. Early engagement with government. Align project with national priorities to ensure buy-in. Contractual protection is critical. Termination payments, change in law, and arbitration clauses must be watertight. Multilateral involvement is a de-risking tool. MDB guarantees often unlock commercial financing. Currency risk must be addressed upfront. Otherwise, FX volatility can erode project returns. 12.12 Conclusion. Political and regulatory risks can make or break a project. The most successful sponsors proactively secure government support, embed strong legal protections, and involve multilateral institutions to provide additional comfort to lenders. In the next chapter, we'll look at environmental, social, and governance (ESG) factors, which have become central to project finance, not just for compliance, but as a determinant of funding availability and investor appetite. Chapter 13. Environmental, Social, and Governance (ESG) Factors. 13.1 Why ESG matters in project finance. Modern infrastructure and energy projects do not exist in a vacuum. They interact with communities, ecosystems, and political systems. Poor ESG performance can delay permitting or lead to legal injunctions, trigger community opposition, and reputational damage. Result in cost overruns, operational stoppages, or loss of concession. Make a project unbankable for DFIs or ESG-sensitive investors. Strong ESG compliance, on the other hand, can attract concessional finance, green bonds, and sustainability-linked loans. Reduce risk premiums, improving debt terms. Build community support, leading to smoother project execution. 13.2 ESG frameworks and standards. Several global frameworks guide ESG compliance in project finance. Most DFIs and export credit agencies require compliance with IFC performance standards as a minimum condition for financing. 13.3 Key ESG considerations. Environmental Impact Assessment (EIA) identifies and mitigates environmental risks, emissions, habitat loss. Climate resilience, designing projects to withstand extreme weather and long-term climate shifts. Resource efficiency, water use, energy efficiency, circular economy principles. Biodiversity offsets, compensating for unavoidable ecological damage. Social land acquisition and resettlement, fair compensation, livelihood restoration plans. Stakeholder engagement, ongoing consultation with local communities. Labor and working conditions, health and safety, anti-child labor grievance mechanisms. Human rights compliance, respecting local and indigenous rights. Governance. Transparency, anti-corruption measures, compliance with procurement laws. Board oversight, independent directors, clear ESG accountability. Reporting and disclosure, annual sustainability reporting, KPIs tracked over time. 13.4 ESG due diligence process. Screening, initial ESG risk categorization, A high, B medium, C low impact. Baseline studies, environmental, social, and cultural heritage assessments. Action plan development, mitigation measures and monitoring programs. Stakeholder engagement, public consultations, community consent, FPIC where required. Independent review, lender-appointed consultants verify compliance. 13.5 ESG in financial documentation. Loan agreements include ESG-related covenants, such as implementation of Environmental and Social Action Plan, ESAP. Regular ESG performance reporting to lenders. Right of lenders to audit ESG compliance. Suspension or event of default clauses for material ESG breaches. Example: a wind project might be required to implement bird bat monitoring programs as a condition of ongoing disbursement. 13.6 ESG-linked financing. Projects with strong ESG credentials can access green bonds, proceeds earmarked for climate-friendly investments. Sustainability-linked loans, loan margins reduced if ESG KPIs are met, e.g., GHG reduction targets. Blended finance, concessional funding from climate funds, e.g., Green Climate Fund, to improve economics. 13.7 Case study, Lake Turkana Wind Project, Kenya. Background: 310 megawatts wind project, Africa's largest, built in a remote region. ESG challenges. Resettlement of local communities. Sensitive cultural heritage sites. Concerns about impacts on pastoralist livelihoods. Mitigation measures. Extensive community engagement and benefit sharing programs. Independent monitoring of social impacts. Biodiversity offsets for wildlife habitats. Outcome: IFC compliant project attracted funding from DFIs, AFDB, IBOPIC. Widely recognized as a benchmark for ESG best practice in Africa. 13.8 Case study, Dakota Access Pipeline, DAPL, USA. Background: crude oil pipeline project that faced intense opposition from Native American tribes. ESG failures. Insufficient early engagement with affected stakeholders. Alleged violations of tribal land rights. Massive reputational backlash, leading to protests and legal battles. Lessons learned. Stakeholder engagement must be proactive and culturally sensitive. Social license to operate is just as critical as legal permits. 13.9 Measuring and reporting ESG performance. Common ESG KPIs. CO2 emissions per megawatt-hour power projects. HSE incident frequency rate. Percentage of local procurement, labor. Community grievance resolution rate. Reporting should be annual and publicly available, ideally aligned with GRI or SASB standards. 13.10 Lessons learned. ESG is a risk management tool, not just compliance. Good ESG reduces financial and reputational risk. Stakeholder engagement is ongoing, not a one-time box-ticking exercise. Climate risk is becoming material. Projects must consider both transition and physical climate risks. ESG credentials can unlock cheaper capital. A strong ESG profile attracts green and sustainability-focused investors. 13.11 Conclusion. ESG considerations are now a core determinant of project bankability. Sponsors must integrate ESG into project design, financing, and operations, not as a compliance burden, but as a driver of value and risk mitigation. In the next chapter, we'll examine monitoring and reporting during operations, where we look at how project performance, financial, technical, and ESG, is tracked over time to ensure continued compliance and lender confidence. Chapter 14. Monitoring and reporting during operations. 14.1 Why monitoring matters. Unlike corporate finance, project finance is self-contained. Lenders rely solely on the project's cash flows for repayment. Ongoing monitoring ensures the project remains technically sound and operates as designed. Covenants and ratios are met, avoiding default. ESG obligations and permit requirements are satisfied. Early warning of issues that could threaten cash flow and debt service. 14.2 Key stakeholders in monitoring. Project company SPV, responsible for generating reports operating transparently. Lender's technical advisor LTA, independent engineer who reviews operations and certifies performance. Lender's insurance advisor, verifies adequacy of ongoing insurance coverage. Environmental and social E&S monitor, reviews ESG compliance and community engagement. O&M contractor, provides operational data, availability, downtime, maintenance. 14.3 Types of monitoring. 1. Technical monitoring. Availability factor, e.g., percent uptime of plant. Production levels, MWH generated throughput, capacity utilization. Maintenance schedules and major equipment performance. 2. Financial monitoring. Revenue collection and off-taker payments. Operating costs versus budget. Debt service coverage ratio, DSCR, and loan life coverage ratio, LLCR. Reserve account funding, DSRA, O&M reserve. 3. ESG monitoring. Environmental management plan implementation. Health, safety, and labor standards. Stakeholder grievance logs and resolution rates. Social impact indicators, jobs created, local procurement share. 14.4 Reporting requirements. Typical reporting obligations under loan agreements include 14.5 Early warning systems. Sponsors and lenders rely on monitoring to identify problems early. DSCR breach, falling below required minimum, may trigger cash sweep or lockup. Off-taker payment delays, early action can be taken before a liquidity crisis develops. Declining technical performance, schedule corrective maintenance before breakdowns. Community complaints, address quickly to avoid protests, reputational damage, or injunctions. 14.6 Role of reserve accounts. Reserve accounts serve as financial buffers to support debt service during underperformance. Debt Service Reserve Account (DSRA) usually covers 3 to 6 months of debt service. O&M Reserve covers scheduled major maintenance. Distribution Lockup Mechanism: if ratios fall below a threshold, cash is trapped until cured. 14.7 ESG Compliance Audits. Many lenders and DFIs require independent ESG audits during operations. Focus areas: adherence to IFC performance standards, implementation of Agreed Environmental and Social Action Plan (ESAP), grievance redress mechanisms functioning effectively, no material breaches of human rights or environmental permits. Example: in many African IPPs, annual E&S monitoring reports are submitted to lenders and disclosed publicly to ensure transparency. 14.8 Corrective Action and Cure Rights. If monitoring reveals issues, sponsors may be required to inject equity cure to restore DSCR. Mandatory maintenance or CapEx may be triggered. Suspension of dividend distributions until compliance restored. Lender step-in rights if performance threatens debt repayment. 14.9 Case Study, London Gateway Port, UK. Background: a major new deep-sea container port project with complex financing. Monitoring approach: detailed monthly operating reports shared with lenders. Early engagement when throughput fell short in first years. Revised business plan agreed, preventing covenant breach and maintaining lender confidence. Outcome: gradual ramp-up achieved, project eventually outperformed original forecasts. Lenders remained supportive due to transparent reporting. 14.10 Case Study, Renewable Portfolio Financing, Chile. Challenge: wind and solar farms experienced lower than expected generation due to atypical weather. Mitigation: continuous production monitoring allowed quick recognition of revenue shortfall. Sponsors injected equity to maintain DSCR compliance. Portfolio refinanced with longer tenor debt once performance stabilized. 14.11 Lessons learned. Transparency builds trust. Proactive reporting keeps lenders engaged and avoids adversarial relationships. Independent verification matters. LTA and E&S monitors give credibility to reported data. Early intervention prevents default. Monitoring provides time to cure issues before they escalate. ESG is ongoing. Compliance is not just a development phase requirement but continues through operations. 14.12 Conclusion. Monitoring and reporting are the lifeblood of a project finance transaction post-closing. They provide assurance that the project is delivering as expected, covenants are respected, and risks are managed before they harm cash flows. In the next chapter, we'll start exploring Part 5, Case Studies, diving into real-world projects across sectors, beginning with energy infrastructure and LNG projects, to see how all the concepts we've discussed come together in practice. Chapter 15, Case Study, LNG Import Terminal Project. 15.1 Overview of the project. Project name: Gulfport LNG Terminal, fictional composite case based on real-world examples. Location: Southeast Asia. Total project cost: $1.8 billion United States dollars. Capacity: 5 million tons per annum. MTPA. Sponsors: International Energy Major 60%, Sovereign Wealth Fund 25%, Infrastructure Fund 15%. Structure: Build Own Operate Transfer BOOT with 25-year concession. 15.2 Project Rationale. Energy security: diversify gas supply, reduce reliance on pipeline imports. Power sector growth: meet rising electricity demand. Economic development: job creation, downstream gas market development. 15.3 Project structure. Special Purpose Vehicle, SPV. Gulfport LNG Company, established as a ring-fenced entity. Responsible for construction, operation and repayment of financing. Key contracts. EPC contract, lump sum turnkey contract with experienced EPC contractor consortium. O&M agreement, long-term O&M contract with guaranteed availability. Throughput agreements, 20-year take-or-pay contracts with 3 major power utilities. Port lease agreement, secures land and berthing rights for LNG carriers. 15.4 Risk allocation. 15.5 Capital structure. Debt breakdown. Commercial bank loan, $800 million United States dollars syndicated 15-year tenor. Export credit agency loan, $300 million United States dollars for imported cryogenic equipment. Mezzanine debt, $160 million United States dollars, higher margin, subordinate to senior debt. 15.6 Financial model highlights. Base case DSCR 1.35x. Minimum DSCR covenant 1.20x. Equity IRR post-tax -13%. Debt sculpting. Debt repayment structured to match stable cash flow profile from take-or-pay revenues. Reserve accounts, DSRA size to cover 6 months of debt service. 15.7 ESG and permitting. Full environmental and social impact assessment, conducted per IFC standards. Mitigation measures, mangrove restoration, fishery livelihood support program. Stakeholder engagement, community consultations, grievance mechanism set up. Independent ESG monitor, appointed to report annually to lenders. 15.8 Insurance program. Construction phase, CAR DSU marine cargo third-party liability. Operations phase, property damage, business interruption, environmental liability. Political risk, coverage for expropriation, breach of contract, currency transfer risk. 15.9 Monitoring and reporting. Monthly operational reporting, throughput availability. Quarterly financial reporting, including DSCR compliance. Annual ESG audit and publication of sustainability report. Lender's technical advisor site visit twice per year. 15.10 Challenges faced. Geotechnical surprises, subsurface issues, delayed piling work, EPC contractor absorbed cost under contract. FX volatility, local currency depreciated, mitigated by USD denominated tariff and hedging. Community concerns, early opposition resolved through livelihood restoration and job training programs. 15.11 Outcome. Commercial operations date, COD, achieved on schedule. Performance, exceeded availability guarantees in first 3 years. Refinancing. After 5 years, project refinanced with project bond at lower interest rate, releasing dividends to sponsors. 15.12 Lessons learned. Bankable contracts are the foundation. Take-or-pay agreements de-risked revenues, enabling high leverage. Government support is crucial. Concession and tariff agreements backed by sovereign support improved credit quality. Early ESG engagement pays off, prevented costly delays and enhanced community buy-in. Flexibility in capital structure. Refinancing unlocked additional equity value once risk profile improved. 15.13 Conclusion. This LNG terminal case study demonstrates the power of project finance to fund complex, capital-intensive energy infrastructure by carefully structuring risk allocation, capital stack, and long-term contracts. It also highlights the importance of ESG compliance and proactive monitoring to ensure long-term success. In the next chapter, we'll move to another sector, transportation infrastructure, examining a toll road PPP project to see how similar principles apply in a different risk and revenue environment. Chapter 16, Case Study Toll Road PPP Project. 16.1 Overview of the project. Project name, Metrolink Expressway PPP, fictional composite case. Location, Latin America. Total project cost, $950 million United States dollars. Length, 65 kilometers. Dual carriageway. Sponsors, international infrastructure developer 50%, local construction company 30%, pension fund 20%. Structure, Design, Build, Finance, Operate, Maintain (DBFOM) under a 30-year concession agreement. 16.2 Project Objectives. Reduce congestion on existing routes. Improve regional connectivity and trade efficiency. Facilitate economic development in peri-urban areas. 16.3 Project Structure. Special Purpose Vehicle (SPV), Metrolink Concession Company set up as ring-fenced entity. Key Contracts. EPC contract, fixed price, date certain with local international joint venture. O&M contract, 30-year performance-based contract with availability KPIs. Concession agreement, grants SPV the right to collect tolls, government retains step-in rights. 16.4 Revenue Model. Unlike take-or-pay LNG projects, toll roads typically rely on user-pays revenue. Traffic risk. Project assumes demand risk, actual toll revenue depends on traffic volume. Dynamic tolling, indexed to inflation with government approval. Shadow toll or minimum revenue guarantee. Government provides partial downside protection by covering shortfalls below a threshold. 16.5 Risk allocation. 16.6 Capital structure. Debt composition. Commercial bank term loan, 12-year tenor amortizing. Institutional investor tranche, long-dated project bonds placed with local pension funds. Multilateral DFI loan, provided political risk comfort and longer tenor, 15 years. 16.7 Financial model highlights. Base case DSCR, 1.35x. Minimum DSCR, 1.20x. Traffic scenarios. Base case, plus 4% CAGR. Downside case, plus 1% CAGR, still meets DSCR covenant. Debt sculpting. Debt repayment profile matched to projected toll revenue growth. Distribution lockup, triggered if DSCR falls below 1.15x. 16.8 ESG considerations. Environmental. Noise barriers near residential areas, reforestation program. Social. Land acquisition and resettlement with fair compensation and livelihood restoration. Safety. Road safety audits, emergency response systems built into design. 16.9 Monitoring and reporting. Monthly traffic reports submitted to lenders. Quarterly financial and covenant compliance reports. Independent traffic consultant engaged annually to review traffic projections. Lender's technical advisor monitors road condition and maintenance compliance. 16.10 Challenges faced. Traffic shortfall in early years. Economic slowdown led to revenue underperformance. Solution. Government provided minimum revenue guarantee top-up. Debt service met without breaching DSCR covenant. Construction delay. Severe rains caused 3-month delay. Covered by force majeure clause. Lenders agreed to limited extension of long stop date. Community opposition. Early protests over toll rates resolved via stakeholder engagement and discounts for local residents. 16.11 Outcome. COD. Achieved with minor delay but within budget. Ramp up. Traffic grew steadily after initial 2-year dip. Refinancing. After year 5, project refinanced with lower cost project bond, releasing equity dividends. Operational performance. Met or exceeded availability requirements every year post-COD. 16.12 Lessons learned. Demand risk requires conservative forecasting. Stress test downside cases to ensure bankability. Government support enhances credit. Minimum revenue guarantees and tariff adjustment mechanisms reduce revenue volatility. Stakeholder engagement is critical. Early community buy-in avoids social unrest and toll boycotts. Blended financing can improve terms. Combining commercial bank debt, DFIs and bonds diversifies funding and tenor. 16.13 Conclusion. This toll road PPP case study illustrates how project finance can be applied to transportation infrastructure, with demand risk. Success depends on robust traffic forecasting, careful structuring of government support, and proactive operational monitoring. In the next chapter, we'll explore renewable energy projects, focusing on a solar farm with a power purchase agreement, PPA, to see how project finance supports the global energy transition. Chapter 17, Case Study, Utility-Scale Solar Farm with PPA. 17.1 Project Overview. Project Name: Sunrise Solar Farm, Fictional Composite Case. Location: Southern Africa. Capacity: 150 megawatts DC. Total project cost: $180 million United States dollars. Sponsors: Renewable Energy Developer 40%, Local Infrastructure Fund 35%, Development Finance Institution 25%. Structure: Build Own Operate (BOO) under a 20-year PPA. 17.2 Project Rationale. Decarbonization: Support national renewable energy targets. Energy security: Reduce reliance on imported fossil fuels. Cost competitiveness: Solar LCOE now cheaper than diesel peaking plants. 17.3 Project Structure. Special Purpose Vehicle (SPV). Sunrise Solar Holdings Limited incorporated solely for this project. Key contracts: EPC contract, fixed price, date certain with experienced solar EPC contractor. O&M contract, 20-year operations agreement with module performance guarantees. PPA, 20-year take-or-pay contract with national utility denominated in USD. Land lease, 25-year lease agreement with local municipality. 17.4 Risk allocation. 17.5 Capital structure. Debt details: Commercial bank loan, 15-year tenor sculpted to DSCR of 1.3x. Concessional tranche, $20 million United States dollars soft loan from Green Climate Fund, lowering blended cost of capital. 17.6 Financial model highlights. P50 energy yield, 310 gigawatt-hours per year. Base case DSCR, 1.35x, minimum covenant 1.20x. Equity IRR, post-tax, minus 12%. Debt sculpting: Amortization aligned with seasonal cash flows, higher production in dry months. Reserve accounts, DSRA 6 months, major maintenance reserve. 17.7 ESG and community benefits. Minimal resettlement required, site on non-arable land. Community trust funded, with 1% of annual revenues for local development projects. Women employed in panel cleaning and vegetation control, local capacity building. Biodiversity management plan, implemented to protect desert flora and fauna. 17.8 Monitoring and reporting. SCADA system monitors energy generation in real time. Monthly production and availability reports, submitted to lenders. Annual independent ESG audit, confirming compliance with IFC standards. Periodic inverter and module performance tests, as per EPC O&M guarantees. 17.9 Challenges faced. Off-taker payment delays. Utility faced liquidity crunch during year 2. Mitigation. Payment guarantee called under World Bank partial risk guarantee. Sponsors worked with government on sector reform program to stabilize payments. Dust soiling impact. Lower than expected generation due to dust buildup. Solution. Increased cleaning frequency, added water-efficient cleaning system. Supply chain delays. Module shipment delays due to global logistics disruptions. Mitigation. EPC contractor expedited air freight for critical components to avoid COD delay. 17.10 Outcome. COD. Achieved within budget and within grace period for PPA. Performance. Generation exceeded P50 projections in first 3 years. Cash flow. DSCR consistently above base case, leading to early dividend distributions. Reputation. Project became a benchmark for future renewable tenders in the country. 17.11 Lessons learned. PPA bankability is key. Lender due diligence on off-taker creditworthiness is critical. Guarantees or insurance may be needed. Resource risk should be conservative. Always model downside, P90, to ensure debt service coverage in low irradiance years. Operational optimization adds value. Small O&M improvements, cleaning frequency, inverter maintenance, can significantly improve cash flow. Blended finance can improve returns. Concessional capital lowers WACC and makes projects competitive in tariff tenders. 17.12 Conclusion. Utility-scale solar projects are an increasingly important part of the project finance landscape, combining long-term stable revenues with positive ESG impact. They showcase how proper structuring, conservative resource forecasting, and blended finance can deliver bankable, investable projects that accelerate the energy transition. In the next chapter, we'll explore digital infrastructure, looking at a data center project and how project finance can be applied in the fast-growing world of connectivity and cloud services. Chapter 18, Case Study Data Center Project. 18.1 Project Overview. Project Name: CloudPoint DC Campus, Fictional Composite Case. Location: Southeast Asia, Tier 1 Metro Area. Phase 1 Capacity: 30 MW. IT Load: Scalable to 90 MW over 10 years. Total Project Cost: Phase 1, $300 million United States dollars. Sponsors: Global Data Center Operator 45%, Private Equity Infrastructure Fund 35%, Sovereign Wealth Fund 20%. Structure: Build Own Operate BOO under long-term co-location agreements. 18.2 Project Rationale. Explosive demand: cloud services, e-commerce, and AI workloads driving demand for hyperscale data centers. Digital sovereignty: government initiatives promoting local data hosting. Stable revenue profile: 10 to 15-year contracts with investment-grade hyperscale clients. 18.3 Project Structure. Special Purpose Vehicle (SPV). CloudPoint DC Holdings Limited established to develop, own, and operate the campus. Key contracts: EPC contract, guaranteed maximum price, GMP construction contract with liquidated damages for delay and performance failures. Operations and maintenance, handled by sponsor's in-house data center operations team. Customer contracts, long-term colocation agreements with take-or-pay minimum commitments. Power supply agreement, secured with local utility, includes renewable power option for ESG compliance. 18.4 Revenue Model. Recurring colocation fees, fixed monthly fee per megawatt of contracted capacity. Power pass-through, electricity billed separately to tenants. Cross-connect and ancillary services, additional revenue streams from interconnection and value-added services. Escalation clauses, annual CPI-based escalator ensures revenue keeps pace with inflation. 18.5 Risk allocation. 18.6 Capital structure. Debt details. Syndicated loan, 10-year tenor sculpted to DSCR of 1.30x. Cash sweep mechanism, accelerated amortization if DSCR exceeds 1.50x. CapEx facility, additional tranche available for Phase 2 expansion upon meeting performance tests. 18.7 Financial model highlights. Base case DSCR 1.35x. Minimum DSCR covenant 1.20x. Equity IRR 14 to 15% post-tax. Ramp up 70% contracted at COD, 90% contracted within 2 years. Exit strategy, potential right listing after full campus build-out. 18.8 ESG considerations. Energy efficiency, PUE, power usage effectiveness, targeted at 1.3, well below industry average. Renewable energy procurement, corporate PPA for 100 megawatts of solar capacity to achieve carbon-neutral operations. Water management, closed-loop cooling to minimize water consumption. Community impact, local hiring and training programs, technology upskilling initiatives. 18.9 Monitoring and reporting. Monthly capacity utilization and power consumption reports shared with lenders. Quarterly covenant compliance reporting, DSCR reserve account status. Annual ESG performance reporting, including carbon footprint disclosure. 18.10 Challenges faced. Supply chain delays, shortage of transformers and switchgear, extended lead times. Solution: early procurement and supplier diversification mitigated delay impact. Tenant credit risk: smaller tenants pose risk of default. Solution: security deposits and bank guarantees required under lease agreements. Energy price volatility: rising electricity tariffs impacted tenant OPEX. Solution: negotiated corporate PPA with fixed tariff to provide price stability. 18.11 Outcome. COD: achieved within budget, 70% pre-leased space generating contracted revenue from day one. Operational performance: exceeded uptime SLA of 99.999%, 5 nines. Refinancing: project refinanced with green loan facility at lower margin after ESG certification. Scalability: Phase 2 expansion triggered within 18 months of COD due to strong demand. 18.12 Lessons learned. Pre-leasing is critical. Securing anchor tenants de-risks revenue and enables higher leverage. Technology and power strategy must be future-proof. Modular, energy-efficient design enhances long-term competitiveness. ESG credentials unlock better capital. Green certifications and renewable sourcing attract cheaper financing. Flexibility adds value. Phased build-out allows sponsors to match CapEx with demand, optimizing returns. 18.13 Conclusion. Data centers are now considered core infrastructure assets, and project finance plays a key role in funding their development. This case demonstrates how long-term contracted revenues, robust ESG strategy, and scalable design create a bankable and investable digital infrastructure asset. In the next chapter, we will move to Part 6, Future Outlook, where we explore emerging trends in project finance, including green finance, carbon markets, blended finance, and the impact of digitalization on project structuring. Chapter 19, Emerging Trends in Project Finance. 19.1 Introduction. The project finance market is constantly evolving in response to climate change, geopolitical shifts, technological advancements, and investor expectations. Future-ready professionals must understand these emerging trends to structure bankable projects and attract capital in a rapidly changing environment. 19.2 Green and Sustainable Finance. 1. Green bonds and loans. Rapid growth and issuance of green project bonds and sustainability-linked loans. Projects must meet clear criteria: use of proceeds, external verification, reporting obligations. 2. Sustainability-linked pricing. Margin step-downs if project meets ESG KPIs, e.g., GHG reduction targets, community development goals. Margin step-ups for failure to comply, aligning financing cost with sustainability performance. 3. EU taxonomy and global standards. Increasing regulatory pressure for green classification and disclosure. Developers must consider taxonomy alignment early in project structuring. 19.3 Blended finance. Blended finance combines concessional capital with commercial finance to make high-impact but marginally bankable projects feasible. Concessional loans or grants, provided by climate funds, DFIs, or philanthropies to improve project economics. Guarantees and risk-sharing mechanisms, lower risk for private lenders, crowding in private capital. Results-based finance, disbursements tied to verified outcomes, e.g., renewable generation, emissions avoided. Example: mini-grid projects in sub-Saharan Africa often blend concessional funding with private equity and local bank debt to achieve commercial viability. 19.4 Digitalization of project finance. 1. AI and big data in due diligence. Faster credit assessment using machine learning models. Improved resource forecasting, solar wind yield modeling, traffic prediction. 2. Blockchain and smart contracts. Potential for automated disbursement based on milestone verification. Tokenization of project equity for fractional investment. 3. Digital twin technology. Real-time monitoring and predictive maintenance of assets, reducing downtime and improving lender confidence. 19.5 Energy transition projects. Hydrogen and ammonia. Emerging asset class requiring innovative offtake structures. Carbon capture, utilization and storage, CCUS, still risky but gaining traction with government incentives. Battery storage, merchant risk mitigation through hybrid contracts, capacity payments plus energy arbitrage. 19.6 Resilient and adaptation projects. Growing demand for financing projects that protect communities from climate impacts. Coastal flood defenses. Urban drainage and water resilience projects. Climate-proofing transport and energy infrastructure. These projects often involve public-private partnerships with concessional support, as revenue models can be challenging. 19.7 Social infrastructure and inclusion. Post-pandemic, there is increasing focus on hospitals, schools, affordable housing PPPs. Projects addressing digital divide, rural broadband, community data centers. Gender lens investing, targeting projects with inclusive hiring, procurement, and community benefits. 19.8 Impact measurement and reporting. Investors increasingly demand quantifiable impact metrics, not just financial returns. CO2 emissions avoided. Number of households electrified. Jobs created, % local workforce participation. Social return on investment, SROI metrics. Expect more mandatory impact reporting in loan agreements and bond covenants. 19.9 Regional and geopolitical shifts. Asia Pacific, dominant share of global project finance deal flow driven by infrastructure boom. Africa, growing interest supported by DFIs and blended finance structures. Geopolitical risk, projects must account for supply chain diversification, sanctions risk, and reshoring trends. 19.10 Case study, Green Hydrogen Hub Europe. Overview. 250 megawatts green hydrogen facility linked to offshore wind. Innovations. Revenue stack combining long-term offtake contracts, capacity payments and government subsidies. Financing included EU Innovation Fund grant, plus commercial debt plus corporate equity. Significance. First of its kind deal structure created a template for future hydrogen projects. 19.11 Case study, Digital Infrastructure Right Asia. Overview. Portfolio of fiber networks, towers and data centers bundled into Right. Innovations. Monetization of mature assets, freed up sponsor capital for expansion projects. Right attracted retail and institutional investors seeking stable yields. Significance. Demonstrated increasing liquidity and institutionalization of digital infrastructure as an asset class. 19.12 Lessons for practitioners. Sustainability is non-negotiable. ESG compliance is now a ticket to entry for financing. Innovative structuring is essential. Projects may require hybrid revenue models, blended finance, or new risk-sharing mechanisms. Data-driven decisions win. Investors expect robust analytics, scenario planning, and digital monitoring. Collaboration is key. Public-private partnerships, DFIs, and institutional investors must work together to close the infrastructure gap. 19.13 Conclusion. The future of project finance will be defined by climate alignment, innovation in structuring, and integration of digital tools. Projects that combine sustainability, resilience, and strong risk allocation will attract capital even in volatile markets. In the final chapter, we will synthesize the key insights from this book and distill best practices for sponsors, lenders, and advisors to structure successful deals in an increasingly complex and ESG-driven world. Chapter 20, Lessons Learned and Best Practices. 20.1 Introduction. Over the course of this book, we have explored the principles, structures, risks, and real-world applications of project finance across sectors, from power plants to data centers. This final chapter distills those insights into actionable best practices for sponsors, lenders, advisors, and policymakers. 20.2 The Project Finance Mindset. At its core, project finance is about risk allocation and cash flow certainty. Successful practitioners think in terms of bankability. Is the risk profile acceptable to investors and lenders? Predictability. Are cash flows robust under downside scenarios? Alignment. Are stakeholders' interests properly balanced for long-term success? 20.3 Best Practices for Sponsors. Early risk identification. Conduct robust feasibility studies, resource assessments, and market analysis. Engage lenders early to test bankability assumptions. Contractual risk allocation. Structure EPC, O&M, and offtake contracts to pass appropriate risks to parties best able to manage them. Secure guarantees, warranties, and performance LDs where possible. Financial discipline. Build conservative financial models with P90 or worse cases. Include buffers for contingency, inflation, and interest rate movements. Stakeholder engagement. Communicate transparently with communities, regulators, and lenders. Invest in ESG and social license to operate. Problems ignored upfront often become expensive later. 20.4 Best Practices for Lenders. Thorough due diligence. Technical, legal, market, and environmental reviews should be independent and rigorous. Conservative debt sizing. Base debt service on P90 or worse cash flows. Require reserve accounts, DSRA, MRA, and cash sweeps for downside protection. Monitoring discipline. Regularly review operating performance, covenant compliance, and ESG reporting. Use step-in rights carefully but proactively if the project is at risk. 20.5 Best Practices for Advisors and Financial Modelers. Clarity and transparency. Build models that are auditable, clearly structured, and well documented. Sensitivity and scenario analysis. Test interest rates, resource yields, CapEx overruns, and FX movements. Present lenders with robust downside cases and mitigation strategies. Clear communication. Translate technical and financial findings into language that decision-makers can act upon. 20.6 Policy and Government Best Practices. Stable regulatory environment. Investors need certainty on tariffs, permitting, and taxes. Avoid retrospective changes to contracts, e.g. feed-in tariff cuts. Risk mitigation support. Provide guarantees, viability gap funding, or concessional finance for socially important projects. Transparent tendering. Competitive procurement attracts global capital and ensures value for money for the public sector. 20.7 Common pitfalls to avoid. Underestimating resource or market risk. Overly optimistic base cases lead to covenant breaches. Weak counterparty assessment. Off-taker or EPC insolvency can derail even well-structured projects. Poor communication. Misalignment between sponsors, lenders, and communities creates conflicts and delays. Ignoring ESG requirements. Increasingly, non-compliance can result in financing termination or reputational damage. 20.8 Future-proofing project finance. Integrate ESG early. Treat ESG as a core component of project design, not an afterthought. Leverage digital tools. Use AI for resource modeling, digital twins for operations, and real-time dashboards for lenders. Innovate in structuring. Explore hybrid revenue models, blended finance, and new forms of risk sharing. Build talent and capacity. Train the next generation of project finance professionals in modeling, ESG, and digitalization. 20.9 Key Takeaways. Bankability is built, not assumed. Every project requires careful risk allocation and contractual structuring. Cash flow is king. The entire deal hinges on reliable, predictable cash flows. Alignment creates value. Well-aligned incentives between sponsors, lenders, and stakeholders drive long-term success. ESG is the new baseline. Projects that fail to meet sustainability criteria will increasingly struggle to raise capital. Adaptability wins. The market is evolving from green hydrogen to digital infrastructure, and practitioners must stay ahead of the curve. 20.10 Conclusion. Project finance remains one of the most powerful tools for mobilizing private capital into essential infrastructure. It brings together technical expertise, legal structuring, financial discipline, and stakeholder management into a single, integrated framework. As the world transitions toward a low-carbon economy, builds out digital infrastructure, and adapts to climate change, project finance will play a pivotal role in shaping a more sustainable and resilient future. This book aimed to equip you with both the technical knowledge and the strategic mindset to participate in, and lead, the next generation of transformative infrastructure projects.